Hello, this is Scott Cooper, and I'm here with Jamie McGurk, and we're going to talk a little bit about technology M&A. Jamie, we put out this piece a couple of days ago where we talked a little bit about some of the trends that are happening in M&A, and the real theme, at least from my perspective, was there's a lot of activity generally happening in M&A and quite a significant volume also on the tech side. But the nature of that M&A, at least from my perspective, kind of seemed a little bit different, which is a lot of kind of more consolidation type deals, a lot of private equity deals, not a lot of what at least we would call kind of real growth stuff where you've got companies buying, very high growth assets and really trying to kind of transform their product line or transform kind of the trajectory of their business. And so we thought we'd spend a few minutes today kind of talking a little bit about, number one, get your perspectives on does that, what are you seeing and do you think that makes sense? And kind of then we'll dive a little bit more deeply into what do we think is going on here and what might obviously cause that to change. So maybe you can give us some perspective, particularly having been in the industry for a long time, of kind of, is there anything different this time? Or do you think what we're seeing is kind of what you'd expect to see at this stage of the cycle? Kind of what's your view as to the kind of health of the tech M&A market?
Yeah, I think on technology in particular, and especially as the growth segment of technology that you point to, I think that what we've seen in this cycle versus previous cycles is that the buyer universe has a lot of different challenges in front of them that they didn't have previously. I think if you looked back at the cycle during the .com boom of 99-2000 or even mid last decade, you had a set of buyers that were growing very quickly. That had the P multiples and the stock price to support voracious M&A activity. And if you look at those same buyers today, be it Cisco or Oracle or others that have been acquired themselves, that just does not exist. So they're not set up in the same way. Despite their large cash balances, they're not set up just from a valuation perspective to be very active.
So that's kind of interesting. So just to make sure I understand, so you're saying kind of in 99-2000 you had. We know we had a lot of IPOs, right? But you're also saying you had a bunch of these big, large tech incumbents like Cisco, for example. And, everybody loves to talk, of course, now about how Apple is going to be the first $1 trillion company. But there was a time in 99 where everyone said Cisco was going to be that company. And I think at its peak, it reached like 125 PE multiple or something amazing like that. And so you're saying that was a more favorable environment from an M&A perspective because you've got big companies with big PE multiples who can afford to do acquisitions that would otherwise look very dilutive, right? But because they've got such big PE multiples, it's a lot easier to kind of use your stock price to actually fuel a lot of that acquisition activity. Is that part of the issue right now?
That's part of the issue, yeah. So I would say that's absolutely one factor. Buyers having to justify dilution, certainly to their shareholders. I'd say that's a very, very big factor. The other which you touch on in your piece is a lot of these companies are either under direct activist pressure or the threat of activist pressure, and so they want to be very cautious in how they deal with use of cash balance, use of their stock price as currency in acquisitions, and making sure that that's aligned with shareholders' best interests, really in the short term. I mean, and right. they're not thinking long term. Larry Fink wrote a letter to CEOs, which he's done on an annual basis now, and one of the major points in his letter was that stop looking so much on the next quarter or this year, returning capital to shareholders in the form of dividends and buybacks, and really invest for growth, which is what is going to benefit your stock price over time, not just next quarter or the quarter after that. Yeah,
we saw, I think, the S&P numbers came out not too long ago for 2014, and it's something like close to $1 billion of buybacks and dividends that have kind of come out of the market, which is, it's a remarkable number. Did I say $1 billion or $1 trillion? I can't remember what I said. I said B. That's B is wrong. It's $1 trillion of buybacks, right? Which is amazing because it's actually, I think if my math is right, it's actually more than the combined net income of all the listed stocks in the U.S. So and that's interesting. And the Larry Fink piece was definitely interesting as well. Now, what's funny to me though is the concept of short-term investors is not necessarily a new concept, but I think at least what, from my perspective, is different, I'd love to hear your opinion on this, is number one, activist shareholders kind of as a group is just a much more institutionalized group than it was before. And we know, if you've seen all the Wall Street Journal numbers, the number of assets under management is something like, up, I don't even know what the multiple is, but it's huge. It's over like $120 billion now in activist funds. So we've always had short-term behavior, but my sense is probably it's a combination of people moving towards index base investing, and then this kind of really quasi institution that's known as an activist investor just has a different role to play probably than they did in the last bubble. Do you think that's what's driving some of that?
It is driving some of that, and I would say just on the activist point in particular, it's no longer as concentrated as it was. So it's not just a few very large funds that used to be like the known activists. It's really broadened out, and so activists as an asset class has really grown in not just in dollars under management, but also in number of active managers that are out doing this.
Right.
So it's a real strategy that, at least in this cycle, has a lot of attention and is gaining a lot of traction.
Yeah, the other piece that I think is also interesting is if you look at what's happened in the buyout world, the kind of leveraged buyout world, the number of new deals there where they're going out and buying a company that's kind of a standalone business for the first time is a lot lower, and a lot more of their activity is kind of intra buyout stuff, right? Where, KKR is buying something that, TPG or somebody else already owned. And, I don't know if these are related, but it seems to me that there's kind of this weird dynamic between the activist investor and the buyout guys, which is the buyout guys kind of were the kind of quasi-activist investors before, because they'd come into what they perceived to be undervalued assets and essentially take them private and obviously, internalize a lot of the value there. And it seems maybe in some cases, the activist guys are kind of rattling their swords right now and saying, hey, look, we're not going to let you guys buy all this stuff on the cheap. We're going to actually keep these companies public, but we're going to, agitate for change and then get the actual appreciation, to ourselves as opposed to it going to the private equity guys. I
think that's a great observation. It's almost private equity restructuring and activism that's happening in the public markets. It's shifted certainly, and as you point out, a lot of the sponsor trades, certainly in tech, you saw Blue Coat just very recently sponsor trade. You've seen much more of that activity.
Yeah, Informatica taken private as well. Yeah, there certainly seems to be some activity there.
Yep.
One of the things that also I noticed, which I'd love to get your perspective on, is we have seen some kind of big ticket growth M&A. So obviously Facebook buying things like WhatsApp or Oculus or Google buying Waze or Nest. So there are some things happening which I would consider kind of growth type investments, right? Where these guys are looking at these companies and saying, hey, this is a new business opportunity for us, and we're not buying these because they're PE arbitrages, right? But we're buying because they're huge growth opportunities. And what's striking to me, and maybe it's just complete happenstance, but both of those companies have dual class stock structures, right, where essentially the founders do control it, and so they're less kind of at the mercy of some of the activist shareholders or the short-termism from the shareholder perspective. And one of the things at least we see in our business, which I know is we see more companies even at the private stage starting to put dual class structures in or having kind of voting control resident with the shareholders. So if that kind of trend continues, do you think that might make more of this kind of growth M&A possible over time if you have a greater proportion of public companies who actually have some kind of dual class or kind of super voting type structure?
It certainly can, and I think that's right. And so it's the dual class stock structure for sure can lead to more growth M&A just because they're not beholden on a quarter to quarter basis to the criticisms of making longer term investments.
Right.
And you see the mindset of even like a Jeff Bezos at Amazon has that mindset too, without the structure in place. But with the structure in place, certainly makes a difference.
Yeah. The other thing we saw recently was, obviously you talked a little bit about it, which is kind of the activist pressure that a lot of these big incumbents have right now, and that's yielding a lot of split ups, right? So we've seen HP and eBay and Symantec, and there's lots of rumors, of course, that EMC might split up. And then we finally started to see, it was interesting the other day, HP announced kind of their first acquisition on the enterprise side of the business, where kind of in their post split up HP Enterprise, I think it's Aruba, if I remember correctly, right? They're buying. So do you think that may be a catalyst for more M&A activity where kind of post split up, some of these guys feel like we now have the flexibility to now actually invest in some of these kind of growth assets and think more about the long term for the business?
They do. Yeah. So it's interesting in a lot of those, and you can point to each different company and the different dynamics of them. But if you look at, certainly with HP, you have a cash cow part of the business and you have more of a growth part of the business in enterprise and printers and PCs. And the same is true of eBay and PayPal, PayPal being the much growthier side of that business. So I think that whether they were hamstrung on more the type of shareholder that they had, like HP, it's going to be a very different shareholder base, I believe, between a more cash return, GARP type shareholder base it's going to transition now with HP Enterprise, I believe, being a more growth focused shareholder base, and it's going to allow for investments in future growth.
Right. So part of the transition as part of these split ups is it's an opportunity for them to kind of reinvent their shareholder base, and because they have to go anyways and tell the new story of what does HP Enterprise mean anyway. So it's an opportunity potentially to get, you're right, less of the value guys in there and say, look, we're going to try and grow this thing, and therefore, if you want to be along for that ride, a different type of shareholder base potentially emerges in some of these companies.
Yeah, it's a different type of shareholder base with different type of return expectation, and therefore a different type of capital allocation from senior management.
So right. So use of cash might actually go towards either R&D or M&A as opposed to pure use of cash going towards dividends and buybacks.
Dividends and buybacks, correct.
Yeah.
That's right.
Interesting. Yeah. The other thing that was interesting, which kind of postdated the article we wrote, but we had LinkedIn acquiring Lynda, right, for $1.5 billion. Which I wasn't that familiar with the Lynda business, but what was interesting to me was, aside from Facebook, which we've talked about, it's kind of the first of the more recent, 2010 plus IPO class to do, it's a meaningful acquisition, obviously $1.5 billion. And it struck me when we were looking at this article that there hasn't been that much kind of M&A from the new incumbent class, right? So Salesforce done some stuff, but nothing really dramatic from a dollars perspective. We haven't seen Workday, we haven't seen ServiceNow, we haven't seen Splunk, despite the fact that a lot of these guys have really significant market caps. How do you think about that? And do you think that's just a matter of time, or do you think these guys are saying like M&A is not going to be part of our core strategy?
I don't think it's the latter. I think it's the former. I think it's more of just a matter of time. I think they're early enough in their life cycle where there's still a lot of organic growth to be had. But I do think, aside from each has done very small technology and product tuck-ins. But I don't think that they would be doing any transformative M&A in the very near term. But I do think that they will ramp up efforts, and that will complement some of their internal R&D investments. And it's only natural. I mean, each has, as has gone out and built corporate development and M&A teams, and I think that in time that they will be more active acquirers as well.
Yeah, it's interesting because at least I remember I was a banker back in the 99 2000 bubble time period, and there was a lot of those newly public companies in 2000 who actually did pretty significant acquisitions. Epiphany was one of our clients back then. I remember they went out and did some. A lot of these guys leveraged their stock price, which were obviously incredibly high, and in retrospect, obviously we all know kind of where a lot of those things ended up. But it's interesting to me that this time, at least, despite the fact that you do have some very high PE multiples and otherwise well-valued companies being slower on the take for M&A. But in some respects, I think actually it's probably a healthy thing, which is they're kind of their organic businesses are probably still attractive enough that M&A isn't as top of a priority for them.
I think that's right. I think that's a big part of it. But also, I'll mention, from a private company acquisition perspective, the opportunities for private companies in this climate to raise capital, if the alternative is sell to X, or I can go raise in the private market where capital is abundant, and it's abundant from not just firms up and down Sand Hill Road, but also from a whole new class of investor. So you're seeing a lot of the hedge fund crossover type investors, a lot of the mutual funds that are now coming in on both enterprise and consumer across the board. And so when your alternative is I can go raise capital at fairly attractive valuations and valuations that, frankly, a strategic that is under the scrutiny of the public markets and potential activists and all those things that we just discussed is probably not willing to make that bet if the business traction isn't quite there yet.
Yeah, that's interesting. Actually, I hadn't thought about that, but you're right. That's a big structural change from kind of the 99 2000 days where essentially, at relatively young ages, like 4.5 years, going public was a real viable option for a lot of these companies. And you're right, there was some crossover money, right? You had guys like Amarindo, and you had a few guys who did that, but you certainly didn't have the influx of kind of the mutual funds and the hedge funds to the extent that we see it today in the private market. So that's interesting. So it's kind of more, there's more choices now for these private companies to be able to continue on their growth path in the private markets, which, to your point also, potentially makes them, unaffordable in some cases to some of these, incumbent buyers.
Yeah, certainly not the only reason, but I think that's one factor. I think that's one factor in the market today that was unique from previous cycles.
Got it. The one thing that we didn't talk about, which I want to make sure we cover, is look, it's very easy, and maybe in some cases people argue it's kind of self-serving for us as venture capitalists sitting here saying, hey, of course we'd love to see more M&A because a lot of the way this business works, of course, is money has to get recycled where we're able to invest in things, and at some point in time we have to obviously return that money to our investors. And I'll speak for myself here, which is yes, I think there is certainly that line of argument, but I think the bigger question in my mind is whether a lot of these incumbent players will actually figure out what is the next kind of wave of product development that will take them to enable them to, I guess, be kind of long-standing companies and enable them to be able to reinvigorate their growth over time. So if you look at whether it's the IBMs of the world or the EMCs and others, tremendous companies obviously who built great franchises, but who have businesses today that are really growing, at best at kind of single-digit growth rates on the revenue side. And it seems to me, if those companies are going to continue to be leading companies for the next 20 and 30 years, they probably will need to think about, M&A as a way for them to actually, enter new product lines and really kind of jumpstart their growth. And so, I fully acknowledge that, we would be the beneficiary of that, but it seems like there's also, kind of almost an imperative for these companies to think about kind of long-term, survival and, reacceleration of growth for M&A.
Yeah, I agree.
So maybe just before we wrap, if you kind of look out, ahead, the next, 12, 24, 36 months, let's take out like big macro issues. So let's assume the market generally stays where it is and we don't have some big, correction or some other catalyst that changes the course of the market. Would you expect to see more M&A in this group? And would you expect to see more of it happening of the kind of older incumbents buying some of these newer guys? Would you expect to see some of these recent IPOs starting to do acquisition? Kind of if you were, guessing relative to M&A volume today and the characteristics of M&A we're seeing today, what do you think that looks like over the next 2 to 3 years?
Yeah, I've been waiting for more M&A opportunity or more M&A activity, I should say. The last couple of years, if you look at cash balances, if you look at the openness of credit markets and where rates are, I would expect more activity than there's been in technology and in growth investing. And I think that looking out over the next couple of years that you'll see more investments in growth versus more consolidation type M&A or sponsor M&A than what we've seen. I would expect to see more growth type M&A. So we've been waiting for it.
Good. All right. Well, I hope you're right. We'll keep looking for it. All right. Well, listen, this is Scott Cooper. We've been talking to Jamie McGurk, and we are signing off. Thank you.